Welcome to Partnering to Create Wealth. I'm David Marcus, Managing Director at New York Private Finance. We provide tailored credit facilities to individuals using illiquid assets as collateral, helping investors, entrepreneurs, and family offices unlock capital without selling assets or incurring dilution. On this podcast, I talk with trusted advisors and capital markets professionals about how they and their clients use debt as part of a smart, long-term wealth creation strategy. Thanks for listening. I'm joined again today by my colleague Brian Bristol, Managing Director of New York Private Finance, which I will shorten from time to NYPF, and one of its co-founders. Brian, welcome back.
Thanks, David. It's good to be back.
In our last discussion, we talked about the group and the product at a reasonably high level. For this episode, I thought we could dive a bit more into the details regarding such things as summary terms of our facilities. Our loans involve a significant degree of customization to address the specific needs of an individual borrower, but there are also a number of key features that tend to be consistent across all our loans. Why don't we start there? Can you talk about those common features?
I'd be happy to do so, David. You're absolutely right that each loan is essentially bespoke, but there are elements that all our loans have in common. I'd say that 80 to 90% of loans are structured along similar lines, but the last 10 or 15% is where the secret sauce is. Anyway, first and foremost in terms of terms is size. We lend from $5 million to as much as $30 million, although the vast majority of our loans falls into the $5 to $10 million range, at least initially. I say initially because many of our loans grow over time as our borrowers' needs grow and as the value of their collateral increases. As their business succeeds and their investments grow in value, we find ourselves in a position to lend more money to them.
Do any examples come to mind?
One of our most successful financings involved an initial loan of $5 million, which grew over about 4 years to something in excess of $20 million. Perhaps I should add that our minimum, $5 million, is not a function of our unwillingness to lend less than $5 million. It's really a function of the overhead required to create one of these structured financings. Without going into too much detail, suffice it to say that legal expenses, appraisal costs, which are required by regulation, and other transaction fees tend to render a loan of less than $5 million uneconomic for the borrower. And our goal is always to do what is best for the borrower. Sounds like motherhood and apple pie, but it is a guiding principle of everything we do.
You mentioned a loan that grew for over 4 years. Is 4 years the typical maturity of NYPF loans?
Actually, no. We lend for anywhere from 3 to 6 years, but most of our loans have tenors of 5 or 6 years. In fact, the minimum tenor, 3, is a function of the fact that we want our borrowers to be very comfortable that they have financing in place that'll get them through a business cycle should one develop over the first few years. And that often happens in the case of our loans. Anyway, virtually all of our loans tend to be repaid in advance of maturity, not because our money is expensive, but because our borrowers' needs change or they develop alternative financing sources that may be more economic as their circumstances change.
Does that mean your borrowers must incur a prepayment penalty if they want to repay prior to maturity?
Not at all. I would say one of the single most attractive aspects of NYPF's loan structures is that we require no prepayment penalties. As I'm sure most of our listeners recognize, this is very unusual, particularly in commercial banking, but also in private banking. And again, it reflects a core principle at NYPF. Our loans are designed to be as user-friendly as we can make them, consistent with the requirements of regulation. Our goal is essentially to enable our clients to grow their wealth as efficiently and safely as possible. If, over the course of a 6-year loan, they find a better solution to fit their needs, we want them to take advantage of it. Accordingly, we encourage our borrowers to accept the longest tenor possible, as there is no downside from a cost point of view. They can prepay at any time with no incremental cost. I'm thinking of one particular loan in which the borrower indicated he only needed what he called bridge financing for a couple of years. We recommended that he take out a 5-year loan, which he did. And in fact, the loan was outstanding for substantially longer than 5 years, and he didn't have to worry about a prepayment penalty. He also didn't have to worry, because we refinanced the loan over time, about having a financing gun pointed to his head.
So let's speak about cost. Financings by New York Private Finance are not inexpensive in absolute terms, but how do they stack up in relative terms vis-a-vis the alternatives?
Now, the key question that everyone asks, no, our money is not cheap, which is the reason we encourage our clients to seek other sources of financing to the best of their ability. To that point, we had one client who controlled a company with incremental senior debt capacity. Initially, he approached us to borrow $10 million, which he was going to use to buy out a partner who helped him get into business initially. We analyzed the balance sheet of his business, which would serve as the underlying collateral. And from our perspective, it seemed that he had incremental senior debt capacity. Accordingly, we told him to go to his banker at the corporate level and see how much more they would lend. Turns out he was able to borrow $5 million from his bank, not personally, but at the corporate level. So then NYPF ended up lending him only $5 million. This worked out better for him because the overall average cost of the financing was lower than it would have been if he borrowed the entire amount from us. And therefore, it was better for us as well. Ordinarily, one might think that we want to put out as much money as we can. In fact, our goal is to put out the appropriate amount of debt in order to ensure that the client has the best personal capital structure for the investments that he's working on.
As you were just speaking, a question came to mind that you then answered as you continued, but I'm going to ask it anyway because I'd like a little more detail. You said you sent the potential borrower back to his business banker to take advantage of the remaining borrowing capacity his company had. How is that something the borrower missed? And how is New York Private Finance able to discover that information about the company when you only lend to the individual?
That's a great question, David. First off, the backgrounds of the bankers at NYPF include commercial banking and investment banking, so we know how to analyze corporate balance sheets. More to the point, however, our clients are people, in this case, someone who's running an operating business in the food services business. He's not someone who spends his days looking at balance sheets and analyzing corporate structure. He also is not someone who calls his commercial bank all the time and says, can I borrow another $1 million, et cetera, et cetera. Well, that's part of what they look for from us. In addition, prior to starting New York Private Finance, we had a consulting business that focused on capital structure for private individuals. I'll say as an aside that during the downturn in 2009, 10, 11, we actually kept a couple billionaires from going bankrupt because we were able to enable them to restructure their personal balance sheets. So personal capital structure and how it interacts with corporate capital structure of underlying collateral assets is something which is a specialty of ours. And again, the whole point is to ensure that the borrower is borrowing the best or most appropriate amount of money at the lowest possible cost for his purposes.
Now I want to hear more about the billionaires you kept from going bankrupt, but we'll leave that for another discussion. Thanks for the added color about the borrower's capital structure. Now let's get back to the cost issue.
Oh, that's right. I ducked that, didn't I? Very convenient. In today's market, we target an all-in return in the mid-teens for a 5 or 6 year loan, with a floor return of 12% and a coupon of approximately 10 to 11%, which is payable currently. The difference between our floor rate of 12% and our target rate in the mid-teens is made up of a structure we call participating interest. Now, clearly, ours is not cheap money, but our clients are not always using us as their primary source of funds. Often, we are more like the last piece of a puzzle that enables the entire puzzle to come together more efficiently than otherwise.
Okay, so maybe it's not cheap, but it's certainly less expensive than mezzanine debt at the corporate level, and it avoids the dilution and therefore the cost of raising equity. But let's zero in on participating interest. What is it? How does it work? And how does the client benefit from it?
Participating interest is a derivative structure created by NYPF to mirror the warrant or equity-linked structures often applied at the corporate level, in particular with corporate mezzanine debt. In essence, we tie a portion of our all-in return to the performance of one of the borrower's core assets. based on the borrower's projections. We agree in advance what that asset will be worth at maturity of the loan and agree to take a small percentage of that theoretical value as part of our overall return. As a result, if the borrower does better than projected, we do better. Conversely, if the borrower does worse, so do we. The benefits to the borrower are twofold. First, although we target mid-teen returns, a significant portion of our return is not payable until maturity, which reduces the cash burden of our debt while the borrower is growing his or her wealth. Second, and most important, by tying a portion of our overall return to the borrower's success as an investor or wealth builder, we align our interests with those of the borrower. In essence, we do better as our clients do better. So we have a strategic incentive to help them succeed in any way we can. In particular, if they hit a bump in the road, and that does happen over the course of a 3 to 5 year loan, we have no incentive to pull that loan, as would happen in a traditional commercial banking situation. Far from it. We have a vested interest in helping them get through that bump in the road in order to maximize their wealth creation and therefore ultimately our return.
And as we've both mentioned or alluded to before, a structural guideline of our loan terms is giving the borrower the necessary time to ride out an economic cycle. That serves both of our interests. So what happens with the participating interest if the borrower repays ahead of schedule? You mentioned that loans don't have a prepayment penalty, but what happens with the participating interest? How do you calculate that?
I'm glad you asked that because participating interest is probably the hardest thing for people to get their heads around when we're talking to them about a potential loan. If you recall, we agree a set of projections at the outset of the loan and agree a percentage that will be allocated to New York Private Finance when the loan is repaid. That percentage is fixed at the outset of the loan. So if the loan goes to term at the end of 6 years and the participating interest percentage was 1.6%, we receive 1.6% of the value of that asset at the end of 6 years. If the borrower repays at the end of 2 years, we receive 1.6% of the value of that asset at the end of 2 years. You may wonder, how is the value of the asset determined? It's determined either because the borrower has actually sold the asset, because some of our people repay us when they sell an underlying asset, or it's done through a refinancing transaction, at which time we hire an independent valuation firm to value the asset so that there's no argument between us and the borrower as to what it's worth.
So you say that participating interest is one of the hardest things for potential borrowers to understand up front. Once they do understand it, do they appreciate the way it truly aligns our interests with theirs? The participating interest ties part of our upside to their success, so we want and need them to succeed. That's a significant benefit to the borrowers.
That's been our experience. Most of our borrowers have been very to phenomenally successful with the investments they've made, which pleases us a great deal. And even if they end up paying us, say, our target return of currently 16%, because we receive all of the intended participating interest, although it's not cheap money, they're very happy because our borrowers have probably compounded their wealth at 40, 50, 60%. Sure, they'd rather borrow at 8%, but there are no alternatives in the private market today to do things like that. So they're happy. But they also, in the cases where a few of our borrowers have hit that bump in the road I mentioned, they have seen how the participating interest creates an incentive for us to work very closely with them. So the alignment of interest is something that, when it comes into play, is a very powerful benefit to our clients, and they recognize that.
Well, I wanted to cover some of the key details of our loan terms, and we've done just that, and all in under 15 minutes, which I'm sure listeners will appreciate. There's certainly more to cover, but we'll leave that for the next time. Brian, thanks again. I enjoyed the chat and look forward to the next one.
Okay, thanks so much, David.
Thanks for listening to Partnering to Create Wealth. If you found today's conversation useful, please consider subscribing and sharing the podcast. To learn more about how we help our clients unlock capital using illiquid assets, visit the New York Private Finance LinkedIn page or visit our website, nyprivatefinance.com. I'm David Marcus. See you next time.